Hello, today we're going to talk about how you can reduce what you pay in taxes, a beginner's guide to legal tax strategy. If you ask most people what they dislike most about their finances, taxes are usually near the top of the list. But here's something important to understand. The tax system isn't just a bill that shows up every April. It's a set of rules that shape how money moves through the economy. Once you understand those rules, you start to see something interesting. Taxes are not only about how much you earn, they are about how your income is structured, when you receive it, and what incentives the system provides. Go ahead and let's talk about the first principle. Tax strategy is about planning. Most people approach taxes, the wrong way. They earn money all year. Then in April, they gather their documents and hope the tax bill isn't too painful. By that point, most people have already missed out on the most important things. The real tax strategy happens before the year ends. It happens when you decide how your income is structured, how you invest, whether you own assets, whether you run a business, and how you save for retirement. Those decisions determine your tax outcome long before you file a return. This is why people who understand the system tend to keep more of what they earn. The second principle, the tax code rewards certain behavior. The U.S. tax code is designed to encourage certain economic activities. It rewards things like long-term investing, business ownership, retirement savings, home ownership, research and innovation, as well as charitable giving. This isn't an accident. Policymakers use the tax system to encourage activities they believe support economic growth. Understanding these incentives helps explain why different types of income are taxed differently. For example, wage income and investment income often receive different treatment. It isn't about avoiding taxes, it's about recognizing how the system is structured. Let's go ahead and take a quick look at strategy 1. Use tax advantaged retirement accounts. One of the most common ways people reduce their taxable income is through retirement accounts. These accounts exist because governments want people to save for retirement. Two common examples are the 401ks and IRAs. When you contribute to certain retirement accounts, the contribution may reduce your taxable income for the year. For example, if you earn $60,000 and contribute $5,000 to a qualifying retirement account, your taxable income may be reduced. The money inside the account then grows over time. In many cases, taxes are deferred until retirement. The idea behind the system is simple: encouraging long-term saving by providing tax advantages. For investors focused on building wealth over decades, these accounts can play an important role. Strategy 2, understanding deductions and credits. Another important part of the tax system involves the deductions and credits. These two concepts are often confused. A deduction reduces the amount of income that gets taxed. A tax credit reduces the actual tax bill directly. Because of that difference, credits are often more powerful. Examples of credits may include education credits, child credits, and energy efficiency credits. Deductions can include things like certain business expenses, mortgage interest in some cases, and charitable donations. Each deduction or credit has specific rules. The important takeaway is that these tools exist because policymakers want to encourage specific behaviors. Understanding which one applies to your situation can meaningfully affect your final tax outcome. Let's take a quick look at strategy 3. Think long-term with investments. Investment income can also be taxed differently depending on how long assets are held. In many cases, investments held for longer than a year can qualify for long-term capital gains treatment. Long-term capital gains are often have lower tax rates compared with ordinary income. This is another example of the system encouraging long-term behavior rather than short-term speculation. Investors who buy and sell frequently may generate short-term gains that are taxed at higher ordinary income rates. Investors who hold quality assets for longer periods may benefit from lower capital gains rates. This is one of the reasons long-term investing is often associated with tax efficiency. It aligns with both investment discipline and tax structure. Let's take a quick look at strategy 4. Business ownership changes tax dynamics. Another major shift happens when someone earns income through a business rather than strictly through wages. Business owners often have access to deductions related to operating their businesses. Examples can include equipment, software, marketing expenses, professional services, and certain travel expenses. For these deductions to qualify, they must generally be considered ordinary and necessary for the operation of the business according to the Internal Revenue Service. Running a business doesn't mean paying no taxes, but it does mean the tax system treats certain expenses differently because they are part of the producing income. This is one reason entrepreneurship can create different tax planning opportunities compared with traditional employment. Now let's go to strategy 5. Timing matters. Another overlooked element is the timing of taxes. When income is received or when expenses occur, can affect which tax year they apply to. For example, accelerating certain deductions into the current year, deferring certain income into the following year, realizing investment gains or losses strategically. These decisions can influence the final tax outcome. Timing strategies are often used carefully and within the rules of the tax code. The important point is that taxes are not only about how much money you make, they are also about when financial events occur. Now let's go to strategy 6. Record keeping is critical. One of the simplest tax strategies is also one of the most overlooked. Good record keeping is extremely important. When financial records are organized, it becomes much easier to identify legitimate deductions and report income accurately. This includes things like keeping receipts, tracking business expenses, and maintaining organized financial statements. Also, separating personal and business finances when applicable. Poor record keeping is one of the most common reasons people miss legitimate deductions. Organization may not sound exciting, but it can make a meaningful difference over time. Overall, the big idea is to focus on after-tax wealth. At the end of the day, taxes are part of the financial system. They are not something that can be ignored, but they also shouldn't be viewed purely as a burden. They are simply a set of rules. People who understand those rules can make better financial decisions. Instead of focusing only on income, experienced investors often focus on after-tax income. It's what you keep and compound over time. Remember, reducing taxes legally is extremely important, and you should be focusing on your taxes all year. If this video has helped, hit the like and subscribe, and we'll make another video next week. Hope everyone has an amazing weekend.